Neil Kashkari was with us, and he said, forget it, the Fed is going to get to 2%, that they have to do that. He doesn't think it's fair to start changing the goalposts in the middle because he's worried the Fed loses too much credibility.
Yeah.
If that's the case, how would that play out if they keep raising rates until they can get to 2% inflation?
So I think that you can get there in a different way, which is if you believe that wage inflation will be in that higher single digit, below 5%, but let's say 3 to 5, not 2%. You can drive 2% productivity growth to also bring you down back to that 2% level of inflation that people are looking at. And so I think people are looking at ways to automate lots of different things, and that activity has been going on for quite a long time. And I think the ability to use generative AI to increase productivity. I think healthcare is an area where it's going to have a huge impact on our ability to drive it.
That's not something you're going to see happen this year.
It's not something you're going to see happen this year, but you're going to start to see the implementation of it this year. I think one of the things about these generative AI tools that we've seen is they're incredible. I mean, it's things that we never imagined a year ago, and it's moving, as we know, at a very rapid pace. But it's still not quite ready for prime time. But I think it's going to be ready for prime time within the next 2 years. We're going to deal with the hallucinations. We're going to deal with the other issues that cause it to be less stable. And it's going to be a tool that can be used to drive significant productivity increase. The large language models, friends of mine who are much smarter than I am about these things would suggest that that's going to become a commodity. That's not the area of competition. It's really the data and the texture of the knowledge that you have about a specific domain that's going to drive competition. So the ability to use this technology as a tool, the large language models as a tool, I think is going to be very broadly applicable.
You mentioned implementing that for your software companies, and I assume that's to get efficiencies on the coding side of things, at least immediately. On the software side, there are gains to be made. But how do you think of AI? Because we always hear about AI in terms of the efficiencies and the gains to corporations, but gains come at losses somewhere else.
Yep.
And so how do you think about that sort of push and pull, and does that influence, companies? We're not going to go here because we think AI will eventually make this sector, make this company obsolete.
Yes, so that's what we're all looking at right now. Where is it the business models are going to be disrupted in a way that the long-term profitability of that business or industry is going to be impaired? So that's a process I think all of us in private equity and beyond are looking at. We're trying to find companies that we think are good companies in great areas where there's going to be tailwinds. And we're trying to bring a set of capabilities to those companies, mostly business expertise that they can't afford at the size that they're currently at, and then help them grow even faster, help them improve their business model. Fundamental to that is to be right about the fact that the growth that you're suggesting is going to occur is secular in nature and sustainable in nature. And that's what we're really driving towards. And so this throws open that question in some of the areas that we had thought would have very long sustainable growth drivers to them, such as SaaS software.
When you look at the future of private equity, I talk to a lot of big investors, family offices. They still have a large exposure to private equity. But this is an industry that thrived from cheap debt and rising valuations, both of which are gone. Is the future for private equity going to be just wringing improvements and efficiencies out of their existing portfolio, or how are they going to generate the returns?
So it's really interesting. I don't think cheap debt has been a great thing for private equity.
Because you have to compete with it.
Because you pay up for it.
Yeah, but it's
and if you look at the vintage, if you look at all the vintage analysis, what are the best vintages? The best vintages are when debt is more expensive and we hit a recession because prices adjust. I don't think prices have fully adjusted.
But is it better for selling your company?
Well, eventually, if you own a company that you think has that strong, sustainable growth trend to it, you'll pick the right spot to sell. Because the selling...
40% of private equity sales in recent years were to other private equity firms, and that's gone too.
Yeah.
And there's no IPOs and there's no SPACs. So
I actually think you're still seeing some PE to PE sales. You're seeing it in these secondary-led these GP-led secondary sales where you have a good company.
Private equity?
We do. We do. So you evaluate.
They're not as good as you guys are, so you can wring more out of them.
Yeah, so we're buying companies, middle market companies, where the prior private equity owner generally doesn't have strong operating capabilities. And so we're looking for something that's proven itself in terms of this secular growth trend, but where we can take we have a team of 22 full-time operating experts in a wide range of areas that we deploy on our deal teams with to our companies as a resource.
So basically, you're buying from bad private equity companies.
Not bad.
Can't do that.
They picked a really interesting area that had good growth. Now, to get that company to the next level of growth, they need to have some of the help that we can provide. So that means that we have to pick very carefully. We have to pick companies that can benefit from that and that still have strong secular growth. We can't pick the ones where what we bring may not be as beneficial.